Verizon Communications Inc. ticker symbol VZ is $37.67 a share. It is down 31% on the year, and we're going to see if this stock is worth a buy. If we look at Seeking Alpha here, you can see that one of the main things about the stock right now is they are going to have their 6.8% dividend yield and likely price gains too. It is a high yield dividend stock that people love, and it's increased its dividends for the last 18 consecutive years. This is a massive thing for investors. So what I'm going to be doing today is taking you to my stock valuation spreadsheet, looking at the discounted free cash flow model and the Ben Graham valuation formula to see if this stock is a buy or a sell. So let's just have a quick look at the share price over the last year. As I've said, it's down from its yearly high to $55 a share down to about 37. If we take the chart even further out for the last 5 years, you can see that back in what was that, round about October was the lowest it's been in 5 years. Had a little bit of rebound and it's dropped back down. So is this the time to buy? Is it going to shoot back up? Even if we take this, even for the last, well, you can see since the 1990s, in recent time, this is the lowest it's been since about 2012. So is this the right time to buy? Let's have a look at my stock summary sheet. So firstly, we will change this to be Verizon. So let me just update the sheet now. 1 second. Verizon, ticker VZ. And you can see here, it has a market cap of 160 billion, price is $37. Dividend yield, as said at the start of the video, 6.18%, and an ex-dividend date of 6th of April. So buy your shares then if you want this to be paid this dividend. So firstly, we look at the PE ratio is less than the market, and the market is currently has an average of about 21.4. Obviously, Verizon is a lot lower than this with 7.45. So the PE ratio is the price earnings ratio. It values the company based on the share price relative to its earnings per share, and the earnings per share is the company's profit divided by the shares outstanding. So it's a way to value the company. And this company, Verizon, has a very low PE ratio. Next, we want to look at the revenue, which is the money generated by the business. And as you can see here, over the last 4 years, it's gone from 131.8 billion to 136.8 again. So it is increasing, yes, but you can see it's been very, very small growth. 131, 128 billion, 133, and 136. So 2019 was a bit of a down year relatively, but overall it has been increasing. So once again, we like to see that. Next, we're going to look at the profit, the net income, which is the sales minus the costs, goods sold, general administrative expenses, operating expenses, everything. Sales minus everything else, and this is up as well, 19.2 billion to 21.2. And if we look over the last 5 years, once again that similar dip in the prior year, but still steadily growing. In fact, they have been able to generate less profit than what they did last year, but revenue was up. But as you can see, overall profit is increasing. Before we get to the next step, can you just please give a like on the video? Let's see if we can get to 10 likes. My channel has kind of died from not posting anything, but I want to see if I can get that back and keep on bringing you guys all these videos that you did previously enjoy, and I enjoyed making as well. So let's see if we can get it to 10 likes. That's quite a amount at the minute, but I'm so glad to get this back. Next, we're looking at the shares outstanding decreasing. Well, why do we care about shares outstanding? If you own 1 share of a company and there's 10 shares outstanding, you own 10%. If they buy back 10 shares, then you would own 20% of that company, and then you would own more share of the profits. And we can see Verizon here are issuing more shares. Not very much, but it's gone from about 4.138 billion to 4.2. So why is this a bad thing? Well, actually, it's turned out not to be, because if they're issuing more shares, they potentially think the stock is overvalued, and they are using this to generate more capital. So if we look over the last 5 years, they've been issuing more shares over at this point here. Well, now the stock, they're issuing more shares at $50 a share, $60 a share, even 40. Well, the stock is now 37. So that's actually worked out very, very well for them. So if they've issued the stock, they've generated capital from it. Now, if they're buying back stock over the next couple of years when it's at $30, then that's turned out very well for them. So normally, yes, this is a negative as per the rules that I have here as my sort of basic stock screener. But because of how the share price has gone, it's actually worked out pretty well for Verizon. Next, you want to look at the free cash flow. Cash from operating activities minus capital expenditures. The more money the company has in free cash flow, more you can pay dividends, more you can pay down the debt, and more you can grow. And saying that, well, it is a negative right now. 16.9 to 10.4 billion. Went to 16 billion, 21 billion, minus 28 in the previous year, and back up to 10. So once again, yes, that is bad that it's been decreasing. But the fact they were negative 30 billion in cash flow, free cash flow last year, and now that is in 10 in the positive, once again showing good signs, even though it is down. So what does that give us overall? Well, it gives us 3 passes, 2 failures. Obviously, the failures being on shares outstanding, free cash flow. But as I said previously, it's not the end of the world. Free cash flow ratio around about 15. Which you would expect to be a bit higher with that very low PE ratio. So I don't think the discounted free cash flow model is going to love this stock based on that. But let's just have a look anyway. Well, what is the discounted free cash flow? It's a way to value a stock based on its expected future cash flows. We determine the value of the investment today based on the projections of what the company will earn in the future. So let's have a look and see what this gives us. A calculated stock price of $21 a share based on discounted free cash flow. But if you just look at the numbers right here, you can see that this has got free cash flow at around about 7 billion and slowly increasing on that. Now, this is because of 2021 and 2022 numbers. So let's have a look and tweak these and see what we think by taking out some of those more extreme numbers. I would say that the revenue is, the revenue growth, we've got it about 1.4%. Analysts think it is actually going to go at about 2.3 to 1.25. So what we're going to do is we'll take an average of these, which is a lot higher because of obviously this minus 2.79 here. So let's bring this average up to 2.5%. That is already bringing up the revenue. You can see the stock's now at 21. Now, in terms of the net income margins, I would say this is a pretty fair estimate. We will increase it a little bit based on the 3 years, which was a bit more of a dip, but I mean, it's only an extra 0.5%. So actually, we'll leave that. The main one is the free cash flow to net income. Really brought down by 2021. So what we will do is we'll take an average. Well, let's first go with this. What if it was the previous year, which was about 49%? This brings the stock to $33 a share. A lot higher once again. Now, if we took an average of these 3, this is going to be very high, about 87%. Let's bring it to 87%. Well, that would say the stock is at about $60 a share, which was previously what it was before it had that massive downturn. So, discounted free cash flow model, I would say overall likes the stock. I would say this is a little bit high. We'll bring this down a bit, but you can see it is about fairly valued based on discounted free cash flow with the numbers where it currently is. Next, we will look at the Ben Graham formula for valuation for growth stocks. This is created by the father investing in himself, Ben Graham. What this does is it takes the earnings per share, the PE ratio of a non-growth company, the expected 10-year growth of the earnings per share, the average AAA bond yield divided by the corporate bond yield. Now, the expected growth rate of Verizon is quite small. Now, we'll go to where Yahoo Finance, where we get this number from. You can see 0.82%. That is the next 5 years. If we look at the past 5 years, 4.3. So we'll remember that number, and we just want to have a comparison when we get this the value out. AAA rating is about 4.56, as you can see here from the Moody's corporate bond, 4.56. So we'll keep that number the same. So what does that give us in terms of the Graham price? Actually says it is undervalued at the minute by about $5, $42.18 a share. Graham price, which is the margin of safety, is about 31. So if it hit 31, that is a definite buy, no questions asked. Now, this is with a very small growth of about 1% over the next 5 years. Now, as I said before, if we go back to Yahoo Finance and have a look at the previous 5 years, they grew at about 4.35%. So just for out of interest, let's plug that number in here, and you can see if they grow as they did over the last 5 years, in the next 5 years, the fair value of the stock would be about $76 a share with a Graham price of 50. So the stock is, well, both the models are saying, yes, if the numbers are as they continue, it's about fairly valued, but with a little bit of growth, this stock could be back to where it previously was. Right, guys, thanks for watching the video. Please give a like if you enjoyed it, subscribe if you're not already, and leave your comments down below. I'll catch you guys next time.